Both stepped and level premiums have their place. When I help you design your plan, it's a process of 3 stages. We determine, number 1, what types of cover are best for your situation. Everyone's different. And then secondly, how much of that cover and for what purpose. And then lastly, but most importantly, how long you need it for. Asking how long you need it for allows us to strategize with the correct premium type for your needs, and is the consideration that's usually left out when dealing with a bank or a broker. You have the option to split each type of insurance up into different benefit amounts as many times as you wish. This example shows the total life cover amount of $600,000 split into a $500,000 portion and a $100,000 portion. You can then apply either a stepped or level premium structure to each portion, depending on the purpose of the cover and how long it's needed. So let's say you need one portion of life insurance to pay down the mortgage for your other half if you pass away. If your mortgage is $500,000, your life insurance benefit could start at $500,000. Then you may need another portion of life insurance of $100,000 to replace your income for a year. These amounts are just examples. If you passed away, the beneficiary would receive the total $600,000. So for the first portion of $500,000, let's imagine you are 40 years old and you plan to pay down a mortgage over the next 20 years. The mortgage will look something like this over that period. If your mortgage is going to look like this, the portion of life insurance you're buying should be decreasing every year along with your mortgage. It usually suits to apply a step premium for that portion of the insurance as it's cheaper cumulatively. We can talk about that in person to see if it suits you. But instead of letting it run away with age and inflation and having insurance sitting there that's nice to have but not necessary to have, reduce the life insurance every year with the mortgage. The step premium stops increasing at the rate it would otherwise and will instead look like this. This way, it will remain affordable over time. By simply adjusting or reducing your life insurance to your mortgage every year, which only takes a couple of minutes every year, you'll save a lot of money over the period you need the insurance. The mistake is taking the set and forget approach, which will make the $500,000 that you originally set up increase with inflation and age and look like the blue premium comparatively. This is what most people are doing. And it eventually leads to people making unwise decisions to cull their insurance. It's usually when they get their renewal notice in the mail. Only buy what you need from the insurance company. For the second portion of $100,000, a level premium can be opted for, which is going to remain affordable and therefore in place over time. This portion you may choose to leave increasing with inflation so that $100,000 will be the equivalent of in 20 years' time.